Okay, good afternoon and good morning to our guests, to our webinar today. Thank you so much for joining us. Today we're having a co-hosted webinar with Siegel+Gale and Seyfarth Shaw, and we're delighted to have with us Maria Booz, Group Director of Simplification at Siegel+Gale, and Scott Pearson, Co-Chair of the Consumer Financial Services Litigation at Seyfarth Shaw. I'm Jessica Kirk from Siegel+Gale, and I'll be moderating. I'm going to turn it over first to Scott Pearson, who is going to go forward with his remarks. Scott, let me just hand that over to you right now.
Okay, terrific. Can everybody hear me?
Sounds good. Well, everybody's they're muted, so we'll have to see for a hand sign.
Okay, and everyone can see the screen okay? All right, so why don't we start off just talking about, why is it that there is a law firm and a branding agency working together? Those of you on the phone who are my clients, who I've done compliance work for, I think are well aware of the fact that I have been preaching simplicity in legal disclosures for quite some time. In the course of doing some, I was actually putting together another webinar and came across Siegel+Gale, which really has been a pioneer on the branding and advertising side in terms of trying to simplify communications, not only in what you would think of as traditional sort of advertising branding work, but in things that really intersect quite a bit with the compliance work that we do in terms of writing credit card agreements and other kinds of agreements for consumer financial products and billing statements and customer communications and all of those things. So we thought it would be interesting to work together, and hopefully you'll find this helpful. So I am going, and we have a hashtag for anybody who wants to tweet during the presentation today, which is SimplicityPays, which you can see here at the bottom. We'll go take a look at Twitter after this is over and see if anybody actually tweeted anything. Okay, so I want to start with the legal background of why it's important to simplify disclosures. And so the first issue is, why would you ever put anything in writing? Obviously, you're trying to document business terms, you're documenting agreements. Sometimes you have legally required disclosures that you need to make. You always want to be avoiding misunderstandings and avoiding fraud claims. This is particularly the case with customer communications and advertising, where sometimes you need to provide some additional information in order to make things that you've said not misleading. You may want to disclaim inferences or facts. You may want to disclaim legal obligations. And then sometimes it's important to document communications that you've had. For example, in today's mortgage world, there is an awful lot of pre-foreclosure communication that's legally required. And so those communications are important, and you want to be able to establish from a legal point of view that you've had those communications and that you've had them in the right way. So I think for a long time, people have said that no one really reads this stuff, so who cares? There's a funny story with this tech company called PC Pit Stop. Anybody who's been involved with the technology world knows that there's this thing called an end user license agreement that's part of lots of software products and sometimes websites and things like that. And so these guys decided to bury in the middle of their agreement this little bonus clause saying, if you contact us, we're going to send you something. And they actually sent $1,000 to the person who finally contacted them after 3,000 downloads. And they thought that this was a pretty funny experiment showing that people never really read these things. But whether people read it or not, it's still important, because you're trying to enforce your contract. You're trying to make sure that the disclaimers that you make actually achieve for you from a legal point of view what you're trying to accomplish. And what we're seeing now is a change in the way that courts are handling these things, whether people really read the documents or not. So the traditional view, which is shown in this slide, and this is an old case from New Jersey from 1902, more than 100 years old. The fact that the plaintiff did not choose to read the paper or the material parts of it before signing and did not know its contents at the time can't, in the absence of actual fraud, relieve him from its obligations. This doctrine arises from the well-settled principle that affixing a signature to a contract creates a conclusive presumption, except as against fraud, that the signer read, understood, and assented to its terms. In other words, you're bound to it. I'm sorry that you didn't read it, but it's binding, period. And, in today's world, a lot of contracts are not signed. For example, in the credit card world, no one ever signs credit card agreements. They are accepted by use of the card, typically, or, sometimes there are some additional ways to accept it. But, you're sent the terms and conditions, and if you use the card, then you're deemed to accept the terms of the agreement. And we now have a lot of e-signatures and things like that as well, which further complicate the issue from a enforcement point of view. Here's another case, this one more recent, also expressing this traditional view. This Burwell case from South Carolina says, as early as 1924, this court recognized that every contracting party owes a duty to the other party to the contract and to the public to learn the contents of a document before he signs it. However, what we're seeing now is a real change in the temperature out there with the court. Paternalistic, we're seeing regulatory agencies become paternalistic, and in fact, the newest consumer financial regulatory agency, the CFPB, really exists for the purpose of paternalism. So this Foulke case from New Jersey from a couple of years ago really illustrates what's going on, and we see this all the time in trial courts, but here are some published decisions illustrating how things are changing from this traditional approach. Here the court said, in sum, the cumulative effect of the many inconsistencies and unclear passages in the arbitration terms within these three agreements compel us to declare them unenforceable for lack of mutual assent. Now, this is you would think from reading that this is a really, really bad contract where the arbitration provision might have been completely buried, but that's not the case. Immediately above the signature line on this contract, this language appeared in big, giant, bold, all caps type. Buyer acknowledges receipt of a true and completely filled-in copy of this retail installment contract. It is important that you thoroughly read the contract before you sign it, including the important arbitration disclosures and privacy policy on the back of this contract. So here the company is directly calling the consumer's attention to the arbitration provision, and yet it's still not enforceable. And there's more. If you look at the arbitration provision itself, they put a line directly above the arbitration provision saying important arbitration disclosures. And this is bolded so that it sticks out from other language in the contract. The following arbitration provisions significantly affect your rights in any dispute with us. Please read the following disclosures and the arbitration provision that follows carefully before you sign the contract. This was a situation where there were multiple documents signed by the consumer. Immediately above the signature line in one of the other documents, it said, read this arbitration agreement carefully. It limits certain of your rights, including your right to maintain a court action. So again, these are the kinds of things that typically you would think if you put something directly above the signature line like that, you're really calling the consumer's attention to it, and yet it still was not enforced in this case. So the background of this is, who's the plaintiff and why is it that the court is ignoring all of this language that, typically you would think would make the arbitration provision enforceable by calling it to the consumer's attention? Well, this plaintiff had only 10 years of formal schooling. She made $10 an hour at the time of the transaction at issue. And at the time that the case was being litigated, she was 65 years old. She was living on Social Security with a small pension. So the courts are trying to protect people like this plaintiff. Here's another example. This is from a recent Ninth Circuit decision called Gutierrez. I don't think this really fairly characterizes this agreement, which was a retail, like a checking account agreement. All right. So now you see that this court is saying that, no one reads these things. No one should be expected to read these things. And even if you do read it, no one can be expected to understand it. And that is the kind of attitude that we're seeing from an increasing number of courts, and it's definitely the attitude that we're seeing from regulatory agencies right now. Okay, so enter Dodd-Frank and the Consumer Financial Protection Bureau. Many of you, the lawyers on the phone, I think are aware of the fact that there is a new UDAP statute that Dodd-Frank created, which includes a new type of bad conduct by a consumer finance company. And this goes beyond deceptive and misleading, and there's this incredibly vague standard called abusive, but it really, really applies to this situation and basically codifies the need to simplify your business communications when you look at what these requirements are. So an abusive business act or practice is one that materially interferes with the ability of the consumer to understand a term or condition of a consumer financial product or service, or takes unreasonable advantage of a consumer's lack of understanding of the material risks, costs, or conditions of the product or service, or the consumer's inability to protect his or her interests in selecting a product or service, or a consumer's reasonable reliance on a covered person to act in his or her interests. Now, the Consumer Financial Protection Bureau now is starting to use this language basically to require companies to make sure that consumers understand what the terms of these agreements are. We no longer live in a world where you send them the terms and conditions and they're bound by it. Now, companies have an obligation to make sure that consumers have a reasonable opportunity to understand, what the terms of these products are and all of that. So this is not entirely a new issue. There's been a relaxed duty to read contracts and heightened scrutiny of contracts in the fiduciary context and also in the insurance context for quite some time. A lot of states have statutory readability requirements. This is quite common for insurance contracts. About 2/3 of the states have objective readability requirements for insurance contracts. Typically, there's like 3 or 4 different tests out there for determining basically how understandable some language is. One of them is the Flesch reading ease scale, and typically these tests are looking at things like, how long are the sentences and how many syllables are in the words and that kind of stuff. And the minimum score under these state statutes is typically somewhere between 10th grade and 13th grade, which is actually, pretty lenient considering that the average consumer reads at the 7th grade level, according to the latest information that I've got. You also see a lot of font requirements and appearance requirements. There are a couple of states that have some requirements for consumer contracts, and I have not yet seen anybody trying to enforce these, but this definitely is a potential class action waiting to happen because I'm not aware of a whole lot of companies that are complying with these statutes. There's one in Pennsylvania, there's one in Connecticut. The penalties can include voiding the contract, statutory damages, and attorney's fees. And typically the requirements involve the different elements that are used in these, reading ease scales, like, use short sentences and paragraphs or limit sentence length, average number of syllables and words. So the enforceability problems that you see in court these days are provisions that are buried, you can't find it, font size issues, and then provisions that are just very difficult to understand. Okay, so this is an example of a required disclosure from a federal regulatory agency. This is the new loan estimate form that just came out from the CFPB, and this is the equivalent. It used to be called a good faith estimate for those of you who have not refinanced since these new rules took effect, or actually I guess they're not entirely in effect yet. In any event, what you'll see here is that if you look at these tables, you'll see it's laid out, in a much more user-friendly way than what you see in your typical agreement, and there's very simple language. Does the loan have these features? Can this amount increase after closing? So it's designed basically for your average consumer to be able to understand it and to make it as simple as you can make it. Now, here's an example of a voluntary plain English disclosure, and this is something that I used in one of our matters that we had with a federal regulatory agency. We had some products commonly referred to as add-on products, where you purchase something and then there are some additional things sold to you together with the main transaction. We took a unique approach in this case and basically went to the agency and said, look, we really want to be a model company, and we want to really change, all of our disclosures and try to make them really unique, put them in plain English, and make them extremely consumer friendly. And it was a really successful strategy because the agency was completely blown away by what we did. We ended up getting a pretty spectacular result in the case. For this particular type of matter, it was the first one where there was no civil monetary penalty in the history of of these types of consent orders. And you'll see that we highlighted some language that was important to the agency. The fact that the products were optional was something that they really wanted highlighted, but it's not all what I would call sort of bad language in here. There's some positive marketing language that we put in as well. The products offer you additional protection and peace of mind, is one thing that we included, and that was completely acceptable to the agency when we gave this to them. And this isn't the final version. This is, just something that was used in connection with the negotiations. They said, this is exactly what we want everybody doing. You can actually understand this. It's in plain English. It's amazing. So now I'm going to turn it over to Maria for some much more detailed thoughts on how you put things into plain English and simplify your communications.
Thanks, Scott, and good afternoon, everybody, or good morning to the folks on the West Coast. We're here in New York. This is Maria Booth, and as Scott said, I'm with Siegel+Gale, which is a strategic branding and communications firm, and I lead a particular practice within Siegel+Gale that we call Simplification, and our focus is on simplifying functional, transactional, and regulatory communications and interactions in all media to make them as clear and useful and customer-focused as possible. So it's a great meeting of the minds, and those were just some terrific examples that Scott was showing at the end, both offered from regulators or some of the own work that they've been doing with clients. And so that's a great segue to what we do here at Siegel+Gale, which is really help our clients figure out how to achieve it. For us, we often begin by saying, well, what are the barriers? And there are some common pitfalls or common characteristics that we would say impede the understanding and clarity of typical disclosure documents. And they're conventions in legal writing that have persisted for a long, long time and are difficult to break free and untangle. Frequently, there are multiple points packed into single sentences as the compliance officers often try to say, well, this is our opportunity to tell the customer everything, so we want to make sure we get it all in there. But that really has the opposite of the intended effect. So similar, if we're padding the key points or the key disclosure with a lot of if-then and tangential information, that interferes with the ability to comprehend the most salient point. There are just some clunky ways of writing that make things longer and difficult to read and understand. So if there are provisions that apply to multiple scenarios, but they're repeated over and over, that causes the reader to tune out and get confused. Often because things are worked on over time, or the precedent of carrying things forward from previous similar agreements or disclosures means that inconsistency can creep in without the issuing institution even realizing it. And that's very confusing when similar provisions or terms are actually talked about with inconsistent terminology or information. Some of the formatting and, again, typical conventions of the way these communications are produced and delivered also impede readability and understanding. The insistence on capitalizing defined terms, or sometimes they're not even defined, really slows down and creates that false sense of formality and bureaucracy that doesn't do anything to improve the legally binding status of those terms. It just interferes with readability. Overall, I think there's what we would characterize as sort of an overzealous formality, again, because of the precedents that are carried forward, and somehow a belief that it's more legal or more binding if it's more formal. We're huge fans of using things like contractions, as you'll see as we go through some of our examples, and just speaking in everyday language, which is every bit as legal and much more understandable. And Scott also touched on some of the issues of just poor information design. Typically, disclosures have very long line lengths and small margins, poor spacing. There's a lack of distinction in the typography, so it's hard to tell what's a heading and what's subsidiary information. So all of those really impede the clarity of information as you're trying to unpack it. So we're all used to seeing agreements and contracts that look very dense, lengthy, and impenetrable in some ways. So the question is, does it have to be this way? And our answer is no, it really doesn't. We can take some of those pitfalls and unpack them one by one, and take dense blocks of text that look like this, and determine that really the information that's required to be conveyed there is much simpler and straightforward. So instead of that huge lengthy paragraph that you see there, what we discovered in the case of this contract was that it simply means if IBM fails to carry out terms of this agreement, you, the contracted party, may be entitled to cancel or be released from it. So that's the level of simplification that we hope to always bring to disclosures and agreements. I think probably by this time, everybody agrees that it's a good idea to attempt to communicate clearly, if for no more noble reason than you have to, because the regulators say that you have to. It's interesting, some institutions have really been quite intrepid for many, many years trying to achieve this type of clarity. As far back as 1984, we were working with Citibank on the simplification of some consumer loan notes. And just from sort of a bird's eye view, you can take a look at the before and after and immediately get a sense of how the document on the right is just conveys that it's going to be easier to read and understand because it's not so dense and packed with information. We're just waiting for that document to come up on the screen. I see we have a slight delay here in our visuals following along. So instead of all of that really lengthy, dense text you see there in the green document, this was another case where we determined that that huge paragraph behind really means only the simple clarification of what default means under this loan note. That I'll, and here it's written in the first person because you are signing it as the party entering into the loan agreement, I'll be in default if I don't pay an installment on time. One of the, to us, amusing stories about some of the simplification efforts is that the process often reveals unenforceable terms and conditions in the product structure itself. We discovered that this loan note from Citibank had a provision that if you take the collateral out of state, you first need to call your loan officer to notify him or her in advance. And given that the vast majority of these loans were used for the purchase of cars, it seemed to be a ridiculous provision, especially if you live in the tri-state area, to say, well, every time I drive over a bridge or across a tunnel, I'm going to call my loan officer and tell him that I'm taking my car out of state. So simplification can really get to the root of some of the underlying causes as well. So how would we describe the features of the simplified document? They're really the opposite of some of those pitfalls we identified at the beginning. It's got a sequence of information that's logical to customers. And grouping of information into clear subsections with descriptive headings. We call that chunking as an approach to information hierarchy and architecture. A very human tone, everyday language throughout. In almost all documents, we recommend speaking as you and we and making it very clearly defined in each case who is you and who is we. And then just to the extent possible, really radically simplifying the language. So in this case, it's about reasonable sentence structure, the use of active voice and contractions and plain English terms. We're very careful to say, though, that there are no absolute prescriptions. Sometimes writing a sentence in passive voice is clearer for reasons of that particular sentence structure or document. We're also careful to say that sometimes simplified language takes more words rather than fewer, and we shouldn't be afraid of adding length. And there are some cost considerations that institutions have to grapple with as a result of that. And embedding explanations that make the document informative as you go along. So there are certain legal provisions that just are inherently complex because the nature of the law demands so to ensure that all parties are protected, obviously. But where it takes a little additional explanation or description to kind of demystify those terms, we're all for adding those in. So those are some of the features that were embedded in that Citibank example. We would say another great milestone, sort of in the greatest hits of efforts to simplify disclosure, came back in the late 90s when, related to some regulatory changes at the time, the SEC also developed the Plain Language Handbook, and we did work with them on creating this handbook and the way it was introduced and rolled out to financial institutions. And we thought it was a great example of the SEC demonstrating genuine interest in helping primarily mutual fund companies understand the how of what they were being instructed to do. So it was a very collaborative effort, not just saying, gotcha when you violate the regulations, but providing very legitimate tutoring and consult on how to achieve that. And so back in the late 90s, you may recall, there was sort of a flurry of mutual fund prospectus simplification that followed this, and that was also sort of the era of insurance company demutualization and a lot of simplification of those materials as well. So that was a great moment in the history of disclosure documents. But as Scott said, there's been a tremendous amount of activity recently, and additional regulation and additional regulatory bodies weighing in on what financial institutions may do or must do. We thought it was very interesting upon introducing the CARD Act that President Obama said, why can't someone design a credit card agreement that you don't need a law degree or a magnifying glass to understand? So we, of course, immediately took that as a challenge and attempted to do just that and created a very visionary prototype of a single-page simplified credit card agreement. I know Scott might take issue with a few of the what could be characterized as oversimplifications, but we were really trying to to be very provocative and make a point here that the most critical information that a credit card customer needs to understand could probably be conveyed in a single page. Now, sort of back to reality. Quite a number of banks and other institutions have really embraced that challenge, and I would say above and beyond what the CARD Act literally requires them to do, and are really rethinking how to simplify a typical credit card agreement. Here's what PNC Bank's agreement looked like just a couple of years ago, which is very typical for the industry. And again, the conundrum of if we want to simplify this, but how do we get started? There are some clues, again, that you can look for. Go back to those pitfalls and say, where are they resident in this document and what can we do to solve for them? So you may recall one of the things on the list up front we mentioned was repeating provisions over and over. So here, where PNC is trying to tell you when interest is added to your account, that is relevant to purchases, it's relevant to cash advances, and lo and behold, the language is identical for each of those types of transactions. So really lengthy repetition of some pretty complex content. So by simply starting out by stating the provision once and then listing the applicable scenarios, you've already eliminated a lot of density to the text and made it a lot less forbidding. In addition, something that we look out for is when knowledge is assumed. You have to remember this is a consumer audience. Scott made some great points about levels of financial literacy or literal literacy, and how can you ensure that you're communicating to meet those lower thresholds. So we noticed in this particular sentence that the term grace period was suddenly dropped in with no prior mention or explanation. And that seems like a very everyday term in use, but if you're a first-time credit card holder, you actually are likely to have no idea what that means. So by contrast, there on your right, you see that we explain that term before we describe when it does or does not apply. So just, again, demystifying what's really insider jargon there. Just continuing through that same document, other places where that same trip-up occurred of repeating very lengthy provisions. Obviously, we consolidated that to eliminate redundancy. This was another case where we found there was a real lack of precision, an actual lack of accuracy when you step back and unpack what all of this means. In that very lengthy section 22, death and inactivity were listed as forms of default. And we would argue that death is actually not a form of default. It's simply a different kind of event. So, just seeking precision in the way those terms are explained and taking something like those long lists out of running paragraph form and using conventions such as bullets or numbers to break up that text is another way to make it much more readable. And then finally, one additional example from this document. Again, we looked at ways to reduce redundancy and consolidate related information, and also to introduce the use of calculations or examples in context wherever possible. So something as complicated, and again, it's an inherently complex subject matter element of how average daily balance is calculated, if we actually break that apart and show the arithmetic steps of the calculation, you go much further in ensuring that somebody will be able to follow the step-by-step calculation and truly understand what it means in the context of their own credit card account. And then finally, embedding an example there that's a real-world scenario. So, if your balance is X and your rate is Y, just making it understandable in terms that people would likely encounter with their own credit card. So that's how we're tackling the plain English approach to the actual content. And then all of those elements of information design also come into play. And when you apply those best practices, the resulting document looks much more consumer welcoming. I think sometimes people are afraid that saying something is customer friendly or user friendly means dumbing it down. And we would argue it doesn't mean that at all. It just means that it conveys the message that you really intend for them to read this document. You're not trying to hide behind fine print. You're not sending it only because it's a necessary evil that the regulators require you to send, but you're really trying to inform and collaborate with your customers to help them achieve good financial health. So just to glance back at where we started and where we've come, the before and after contrast is pretty dramatic there. So those are just a couple quick examples to help you envision what we mean when we say simplification of all forms of disclosures, agreements, and other transactional communications. How would we summarize the key factors for success? I think there are a few that are really essential. Again, we're huge advocates of beginning with the customer perspective, understanding their needs, their levels of literacy, their level of understanding, and using that as your guide for how you clarify and emphasize the most important information. Obviously, we've talked a lot about smashing a lot of those old conventions for legal writing, so getting rid of the excessive capitalization and excessive formality in the language and using more everyday terms. And communicating very clearly in all the channels that customers want and allocating reasonable production budgets to achieve that. So, I mentioned sometimes simplified communications require a little more length. Sometimes they require a commitment to deliver them in alternative media. So more and more people want to receive things on their smartphones, on their tablets, online and in print, and how do you ensure that it's a really consistent and clear experience regardless of how people choose to receive the information. This will be a tough one for some people listening in this audience today, to truly limit the exclusions to those that are commensurate with risk or exposure. In some ways, this is the old, don't stand in a foot of water while you're using your hairdryer type of exclusion, or I think particularly when you look at some of the card products, those are all forms of insurance, and the exclusions identify some of the most extreme and unlikely possibilities. And if you actually calculate the risk to the institution, if you didn't include some of those particularly outlandish exclusions, I think you'd find the risk is extraordinarily low, and perhaps therefore not worth burdening your entire customer base with some of those provisions that are really not material to the core product or service that you're delivering. We would also recommend investing in real research to measure and validate comprehension and usability. We are actually not advocates of readability formulas because I think they give a false sense of security about whether something is actually clear and understandable. A document actually can be quite unclear and receive a low readability score, and again, that gives you that false sense of comfort. Because all of the readability formulas available are based on sentence length and paragraph length, word count. They're all these quantifiable metrics. You could actually run most text backwards through a readability formula and achieve the same score. So I think that that gives you a clue about how they're pretty unreliable in judging real comprehension. But they're cheap and immediate and easy for comparison because you do get a quantifiable metric, and I think that's why companies are drawn to them and why some regulators insist upon them. For example, in the Medicaid community in some states, you are required to use readability formulas. We would argue instead that it's just a shortcut around true research that will document whether people are understanding and likely to take the appropriate action that can only be revealed through true consumer research. And finally, we would say it's critical to work as an integrated team from the outset to prevent a patchwork approach. So even though everybody has the best intentions, if the product groups are working with legal and compliance from the outset, as well as with operations who have control over the channels in which these communications ultimately are delivered, you're likely to get a much better solution and to sort of circumvent some of those pitfalls from the very beginning. So that concludes our prepared remarks for today, and I know you are all invited to submit questions through your screen, and I think we have about 15 minutes left. If some folks would like to type in questions, we'd be delighted to take them for you.
All right, this one looks like it might be best for Scott to address first, so I'll read it aloud. It's the CFPB and new regulations that apply to consumer finance may require simplified disclosures and notices, but how does a company balance that with existing case law that may require some specific language or legalese? And Scott, let's unmute you so you can, are you unmuted there?
Can you hear me now?
Yes, great, thank you.
Yeah, I had my mute button on. I was actually going to chime in on that last point on your last slide, and I was talking and no one could hear me, but now I know why. Let me answer the question first, and then I'll go back to what I was going to say on that last slide that Maria showed. Look, clearly you're dealing with a balancing act because there are going to be situations where there is some particular language that you want to use. Maybe there's a safe harbor in a statute that you want to take advantage of, and if the statute has which says you want to use that language, but look, you're trying to simplify your agreements and your disclosures as much as you can weighed against the legal needs that you have. So for example, looking at that single page credit card agreement, I mean, you need to have a TCPA provision in there, a Telephone Consumer Protection Act provision in a credit card agreement, period. You just have to have it because there's a lot of liability, there's a lot of exposure, there are things that you need to have in your agreements, but you try to get as much simplicity as you can, make things as consumer friendly as you can, subject to whatever you feel you really need to do from a legal standpoint. And so now chiming in on that last point on Maria's last slide, one thing that's important in this context is we are seeing now a lot of discovery and consumer class actions focused on the drafting process for agreements. I think it's quite important if you're going to undertake a simplicity project like this, you really want, let's say that you're going to hire Siegel+Gale or a firm to assist you with that. If the marketing department does that retention rather than the legal department doing it, then you have a reduced ability to protect that, all of those communications. It's much better to have in-house counsel run the process, or better yet, have outside counsel run the process so that you can protect the communications using the attorney-client privilege and the attorney work product doctrine. Because the worst thing that could happen would be to have some outside consultant, sending you emails saying you really should, make these changes to your agreement, and then those changes get rejected, and then that's discoverable in a case. You don't want that to happen. So best to have in-house counsel involved from the beginning for that reason, and because in-house counsel, particularly when you're supporting a business unit, have a dual role, it's a little cleaner and a little better protection of the privilege to have outside counsel as another sort of filter between your outside consultant and the marketing people.
And Scott, I'll just add one additional thought on the original question about working within sort of the requirements or the models that the regulators have provided. Our last comment about engaging all of the stakeholders from the very outset, we should expand that to include the regulators. And in our experience with clients, the regulators are actually delighted to have someone bring to their attention that there are perhaps alternative treatments that exceed the level of clarity or simplification that they themselves had put in the models. We're currently working with a large health insurance company that has brought conceptual improvements to the Centers for Medicare and Medicaid, including the validation from user testing that supports that consumers did find the proposed format more understandable than the CMS model. So I think that there's really opportunity to think about the next level of transformation involving the regulators themselves.
Thank you, Maria. Scott, I'm going to address this one again first to you. The CFPB released disclosure guidance last week related to APR promotions by credit card companies and mentioned Reg Z, suggesting that marketing materials should include detailed cost information. Is that how you read the CFPB bulletin, and why it mentioned Reg Z in a marketing context?
The bulletin that came out on credit card promotional APR offers, I think, is focused on the issue of, I think it's a pretty narrow issue the way that I read it, which is, and this is pretty typical of the CFPB in my dealings with them, they will find some area where they think that consumers just don't understand something, and sometimes it's directly disclosed in a document, but not in a way that makes it sufficiently clear to the consumer. I think that that document, that bulletin, really can be addressed through some simple language explaining to people, what the risk is of losing a grace period on one of these promotional offers. Let me look at this question, make sure that I'm answering it directly. CFPB release disclosure. I'm not so sure that the bulletin is focused so much on cost information as it is on loss of grace period. I actually have it sitting on my desk right now. I went through it kind of quickly, but my recollection of that bulletin is that the focus is on the loss of a grace period rather than detailed cost information. But again, in my experience dealing with the CFPB, I think the more consumer-friendly you make things, the more they're going to like it.
Okay, great.
And feel free to follow up if I haven't answered that adequately.
All right, the next question seems to lend itself very much towards Maria's expertise. Maria, our participant asks, has there been any thought given to including pictorials or images as a supplement to increase understandability?
Sure, I would say that's an important arrow in the quiver, or another element to bring to any simplification effort. And I think you phrased the question pretty well as referring to it as a supplement to increase understandability, because there is a lot of academic research that supports that some people do receive information in graphic forms more readily, and some do not. So I think it's great to present readers with alternatives to how to perceive the information quickly, particularly if they're skimming through and want to get a sense of it at a glance. So I would say supporting or representing some of the same concepts that are detailed in the text with information graphics or imagery or charts or tables is a great supporting element to introduce.
Okay, great. So as a reminder, we can have your questions, if you have any more questions, to submit over the portal here. Those were 3 very good questions. We'll just give it a moment here. Okay, if we don't have any more questions at this time, we're going to thank you very much for participating with us today. Thank you especially to Maria Booth and Scott Pearson, our guest speakers today, bringing you this great collaboration across legal and marketing to bring greater clarity for consumers. Thank you so much for participating, and we look forward to seeing you again soon.